Good afternoon, everyone. This is Kim Schmidt, Executive Editor of Farm Equipment Magazine. Welcome to our latest webinar in conjunction with the Western Equipment Dealers Association, Equipment Dealer Consulting, and the Dealer Institute. Today, we're going to dig into the results of the 2020 Cost of Doing Business study, and a special thanks to Iron Solutions, who was a sponsor of the Cost of Doing Business study this year. Our presenters today are Kurt Kleppel and Trent Hummel. Kurt's worked with regional associations in the farm equipment and hardware industries for over 35 years. Currently the CFO for Western Equipment Dealers Association and the president of Equipment Dealer Consulting. Equipment Dealer Consulting has been a longtime partner with WEDA and provides accounting, audit, valuation, and tax services to members of the association. And Trent's a fourth generation farm equipment dealer from Alberta. In 2010, he sold the dealership and began working with other dealers through training and consulting. And he designs and delivers curriculum-based training, on-site consulting and services, and facilitates 20 group meetings. Before they get started with the presentation, just a few housekeeping items. On your screen, there's a control panel with a Q&A icon. You can submit questions here at any time. And if it's related to a specific slide we're on, we'll interrupt Kurt and Trent to ask that question. Otherwise, we'll answer the questions at the end of the presentation. And then just a quick note, we are recording the webinar, so a replay will be available to review later or to share with other members of the dealership. Okay, we are ready to get started. Thanks again for joining us, and take it away, Kurt and Trent.
All right, thanks, Kim. Good afternoon, everyone. We'd like to thank, like Kim said, Iron Solutions and West Texas National Bank for sponsoring the Cost of Doing Business study for 2020. And with that, we'll go ahead and proceed on the slides. A little history and methodology on the Cost of Doing Business study. We've been doing it since 2005. Around May 1st, we request data sent to participating association dealer members. And then in a few months, we usually give them like 2 or 3 months to submit their financial statements to us, and then we compile them and present the study. Next, please. The participating associations we like to thank would be Midwest, Southeastern, Northeast, United, of course, WEDA, and Deep Southern. And if anybody's a member of any of those associations and you actually sent in your financial statements, you can get a free report for participating. So just contact your regional associations and they will send a report for free. And then they're all region Pacific reports. So not only do you get the North America and the volume categories in the study, but your study is also by your region. So that's very helpful. Next. This is just the map of the area that the CODB study absorbs. As you can see, almost all of Canada is involved, and then quite a few of the states in the United States, all the East Coast, most of the Midwest, and then Washington, Oregon, Idaho, and Alaska are involved. The value of the CODB study is not only just for the members to use in their daily business activities, but also one of the key deals that we used the Cost of Doing Business study was for the enactment of the floor plan interest deduction. It is very key information that we sent to the congressional committee that me and Eric Warham were involved in the tax legislation a couple of years ago that really enabled the floor plan interest deduction to make its way into law, which saved quite a few dollars for our farm equipment dealers all across the United States. So the CODB study is actually not only for the dealers, but also a very big, important study for the industry and also for legislative lobbying that WEDA does for all the members involved. It also sets benchmarks for the industry, helps businesses for mergers and acquisitions, helps in estate planning, and helps our DI trainers for training courses in inventory, parts, and service. I know Trent uses it quite a bit, and I know all the other Dealer Institute trainers use it, and also we have quite a few banks and also Iron Solutions that use the CODB study. So it's very important. We want to thank all the dealers that participated in the study this year. The CODB report is actually 4 reports in one. You get your individual association reports, which includes 2020 and 2019 data, so you can compare one year to the next. And also the North American averages, which includes 2020 and 2019 data. Also, the CODB reports include the dealerships by volume. We were going to change those categories this year, but with COVID-19 and the time limit that we were involved in, we didn't get that done. But we have 3 volumes: low volume under 25 million in sales, mid volume 25 to 75 million, and then large volume over 75 million. Next year, you'll probably see 50 million and below, 50 to 150 million, and then anything over 150 million for large volume. I think that's the way the industry is trending, and would be more representative of the volumes that we face now than what we have before in the past. Also, the charts and graphs with the 5-year histories are very informational, and I know Trent uses them quite a bit too. A few things to note: these averages are per location basis. The data is converted from the Canada into US dollars, so we can compare apples to apples. And to make clarification, the 2020 report is on 2019 data, and the 2019 report is on 2018 data. Mergers and acquisitions, as everyone on this webinar knows, it's still happening and will continue to happen. We did see quite a bit of an increase from 3.9 to 4.79 from 2019 to 2020, which is basically 2018 to 2019. I think as the way 2020, the actual year 2020 is going, you're going to see that number be even higher on the next cost of doing business study, because I've been seeing more organizations that have 10 to 12 locations merge with organizations with at least 6 or more. So that number is probably going to go up quite a bit in next year's study. Don't you think, Trent?
Yeah, it's not slowing down at all. There's more dealers talking to each other than ever. Lots going on in that part of the business.
Yeah, agree. And also, you're also seeing other manufacturers, getting involved in the merger and acquisition industry, and so I think you're going to see a lot more happening there, because you're seeing all the other different manufacturers start consolidation too. Okay, now we're into some numbers, the North America revenue numbers. I'll let Trent start talking on some of these numbers and what he sees.
Well, you can see the big jump from 2018, which is in actuality is 2017 dealer reports. So it was a huge jump. It's got to be, and Kurt, you can help out. There had to be a whole bunch of different dealers reporting to have that much of a jump from 2018 on the screen to 2019. Now 19 and 20 are staying the same or very similar. So I'm assuming that a lot of the dealers that reported in 19 are the same ones reported in 20. There wasn't a big variance, but there had to be some kind of a huge variance to have that much of a growth in 1 year. Now, parts, you got to love parts jumping $500,000 and service jumping that kind of money. But from 10 million to almost $11 million to average to 15, staying flat, that's actually fairly promising, because some dealers in 2019 had a lot of trouble, or in 2020 on this screen here, sorry, had a lot of trouble with sales, and they were dumping units and holding on to units and nothing was going on. So this was fairly promising to be consistent with the 2019 numbers. But Kurt, can you comment on that? I think the reason why you see a jump in 2018 to 2019 is, remember, in 2019 we had a lot more higher volume dealers participate in the study. So I think that's why you see the biggest increase in new whole goods and used whole goods and parts, and also in service. So I think that's the main reason. And this year we've had about the same high volume dealers that participated.
And the rest of the volume dealers, medium volume dealers and smaller, low volume dealers stayed about the same as 2019. So I think that's why you see the consistency. So.
Okay. Next slide.
Yeah, turnover, turnover was always a big barometer for the industry. And as you can see, the asset turnover actually dropped in 2020 compared to 2019. Not much, but a little bit, from 2.35 to 2.13. Inventory turnover, parts and whole goods, also dropped a little bit. And, what do you think is the reason for that, Trent?
I don't know. Well, this is a hard metric because we like to break out parts and whole goods separately, but in the report it's together. And the target, I put a question mark beside the target because I got dealers telling me it's can only ever be 2 in whole goods because you'll never get higher than 2. And I got dealers that say we'll never do less than 4. That's our target. So I don't know what the target is anymore. Everybody's got their own, what they feel they can accomplish. And then when you throw parts into it, it throws it out of whack.
Yeah, I think so, because I think normally you'd like to at least turn parts, 5 or 6 times, hopefully maybe during the year or so. And then again, also with new and used inventory, you probably, you definitely like to see that turn at least twice. So, with parts and whole goods, that's another thing that we should look at in separating the turns and getting more information from the dealers, so we can do just a parts turn and then just a whole goods turn. And we can maybe develop that into next year's study.
Yeah, yeah. And now the turnover by category, this is the one that I really want to point out here. You can see the under 25 million it took a big jump, and the 25 to 75 million, the mid category has stayed the same, but that over 75, I was talking to my dad about this, showing him, and he's, 10 years ago, 8 years ago, we all talked about these great big complexes. Will they ever make it through a downturn if we ever have one? Those were great big years, 2010, 11, and 12, and things were rolling and they could survive. But we've just went through, 5 years of not very good, not very active business. Now we've survived, but look at their turns have improved. These guys have figured it out. They're going to be a contender. They're not going away. The big complexes are not going away, as much as I hear some dealers say, oh, that guy will never survive. He's never going to stay afloat. Well, their turns are just about double what the smaller guy is. And that's where your cash is. And they're managing the balance sheet a lot better than the under 25 million guys. So I just don't want anybody to think that, oh, they're all going to collapse one day and it's going to go away. We just went through 5 years of hell, sort of, for most dealerships, and they're doing just fine.
Yeah, and I think also you're seeing the larger complexes and even the middle complexes, manage inventory maybe a little bit better than what we used to back in 2011 or 12 when everything was going great guns, and then 15, 16 is when the used inventory market hit. So I think everybody's learned from that market crisis that we went through back in 15, 16, and finally maybe ended in 2017.
Well, and the other thing that's going on is what I've seen these bigger, larger complexes do is they quit focusing on the income statement and they're more focused on the balance sheet. They're managing their cash because they know that there's a lot of cash, there's a lot of risk out there, and they need to manage their cash. They can't work out of a, $100 million error, where an under $25 million store, it can work out of a $1 million error, no problem. But they've just got more focused on the balance sheet, where everybody needs to be. Next slide.
Hey guys, we did get one comment on that last slide I wanted to share. It said that ag dealers are targeting parts turn under 3 times because the 2.5 to 2.7 range high performance dealers are okay with it. And then parts availability is the #1 reason why customers switch brands. So dealers are okay with higher parts inventory.
Yeah, I mean, go ahead, Trent.
Well, and Kelly's right on that, because, if you have $700,000 of parts in a location, or you have 750, it's not like not like whole goods where you're stocking 5 million or you're stocking $8 million. That $50,000 worth of parts can make a difference. $3 million worth of inventory per location can be crippling. So.
Yeah, and I just kind of make a comment. It'll be interesting to see what those turnovers are going to be for 2020, because as everybody knows on this webinar, that parts inventory has been hard to get in most brands, and also even new inventory, just because of COVID-19 and how it disrupted the whole transportation and production model that we've had before in the past.
And it's somewhat easier to stock parts on a guess, because you have, most manufacturers offer some type of return privilege. So you can send them back. I know a lot of guys in whole goods that would like to send back a few whole goods items, but the manufacturer won't accept them. So
Yeah, exactly. And just breaking down inventory as a percent of total assets, I'm looking, and this information isn't available on the screen, but I'm looking at the different volume categories, and it's kind of interesting. They're all pretty much the same. Under 25 million, inventory was 78.99% of total assets. 25 to 75 million, it was 77.77% of total assets. And dealers over 75 million in sales, their total inventory is 78.86% of total assets. So it's pretty consistent between all the different volume categories.
yeah. And so now here's the whole goods inventories, which, I mean, the target, Kurt, you tell me, but the target's supposed to be under 65% of whole goods inventory as a percentage of assets.
Right.
And we've been pretty safe. We haven't gone too far over, except for 2015 and 16, which we know those were some disastrous years for us, and our inventory got high, and it was a high percentage used there. But this is another one that I don't find dealers really watching that often. And this is one they should. They should always be calculating how much percentage of my total assets is in whole goods inventory. I need to keep that under 65. Even if I can get it down to 60, then you're not in such a high risk. You're not taking big chances on carrying too much inventory. So keep an eye on that.
Yeah, and the one good positive thing with this trend is the 2% decrease in used equipment. I think everybody would rather have the decrease in used equipment than the increase in new. You feel a little bit safer, I think, but you're right. I mean, 65% and below is the ideal target, I would think.
Yeah, next slide.
Yeah, dealership equity, you see quite a bit of a drop really between 2019 to 2020, 33.3% compared to 29.6. And the biggest drop we actually saw was then when you guys get your study and look at the volume categories, the high volume dealer dropped the most in dealership equity. It went from, let me see here real quick. It almost dropped 3 or 4% from a year ago. And the other volume dealers, actually the mid-volume dealer actually increased. So we saw the biggest decrease in the larger volume dealer. And, I think part of it might be the little bit of increase in inventory, which would cause more increase in payables, which would automatically cause a decrease in equity, of course. So, Trent, do you have any comments on that?
The other thing that happened with those big guys is you're right. They had big yards full of overpriced used. They just hit the market and they sold that stuff for what it was worth, and they took their hits, and in that they lost some equity. But you remember back to the slide that showed the turns, they had the highest turns of all three categories. Well, yeah, they're going to have high turns when you're blowing out your stuff because you're getting rid of some of that. So this all kind of marries up to with what happened in 2019 in the calendar year for business.
Yeah, I agree. And I think, 29.6 is still pretty close to 30%, which is really a pretty comfortable percentage to be involved in the industry, really.
Next slide, please.
Yeah, whole goods gross margins, we talked about that, and I'll let you talk a little more about that, Trent.
Well, I want you guys to look at 2015 and 16 when we were showing, 6.8, 7.2, 2017 was 7.3 on new, and then look at how low it was in used. And we've always said in this industry, you should post lower on new and higher on used of gross margin, because if we go for more margin on new, we automatically drive down our used gross margin. And if we bring down our new gross margin, our used gross margin goes up. So either way, we're only going to end up with the total over there on the far right side at 5.2, 5.5, between 5 and 6. Now, the other part of this is only what's selling. I got a lot of dealers that still have yards full of 3 and 4 and 5-year-old birthday kind of equipment. And if dealerships actually sold that stuff for fair market value, that used equipment margin wouldn't be 4, it might be 2 or 1 or something like that. But I mean, fair enough, that stuff has got 3 or 4 birthdays on it, some of that stuff, and that loss of margin should have been scattered out amongst the year that it was taken. But this is a telltale that if we ask more margin on new, we just don't get it on used. That's what this slide is all about. And as much as you want to say that we're getting 7 and 8 and 9 and 10 points on new, we're just not getting it. I mean, we might show it, but then by the time we factor in our numbers and do our cost of sale and so forth, it's just not there.
Trent, do you think there's a difference between the used equipment held by dealers in the United States compared to that in Canada? Because it seems like maybe there's been a little bit of a timing difference there.
Well, for sure, in the calendar year 2019, Canadian dealers were in a real wreck with too much used. And they made some moves in 2019, and they shorted themselves orders in this calendar year, business year 2020, for new orders. So they had most of Western Canada's had a fairly good run at cleaning out their used equipment. They had a great opportunity. The market was really active during COVID here, and they got rid of a lot of stuff. I know dealers that are cleaned right out. So their pre-sales will be high this fall, going on right now, I'm sure. Their yards are empty. There's going to be a lot of business being done. I don't see this winter at all. I've experienced this about 3 times in the last 20 years where the winter months never slow down one bit. If you're out there banging on doors, there is deals on every corner. You just got to kick it up a bit and don't back off right now. This is when it's hot, and it'll be hot right through until springtime. There's just too much activity in the world buying grain to shore up. Countries are shoring up their food reserves because they're scared that COVID might shut down a shipping ports, and then they'll be short of food. So they're buying like there's no tomorrow. So this is going to be one great winter.
Yeah, I agree. And probably a very questionable winter too at that, right? I mean, not everything that we've seen in 2020 happened so far.
Yep. Next slide.
Yeah, go ahead, Trent. This is your wheelhouse.
Well, the target is to have the industry. We need to have, of our total store sales, we want to have 20% of them in parts, and we haven't hit that at all in the last 6 years. I mean, we've come close, but look at 2018. It was 19 million or $1.9 million worth of sales, had us at 18%, and now we're up to 2.5 million. It went down, so that's good. So that means that the other parts of the store are growing right along with this. But boy, if there was ever a time to get focused, and Kelly's probably just chomping on this right now to jump in, get focused on aftermarket and get those part sales up to where they're 20. Just figure out how you're going to do it. I don't know how. Every store's got their own little niches that they can work with, but this is a big deal to get this up, because when you get this up and absorption starts hitting 80, 100%, you're in a driver's seat as a store.
Do you think some of the reason on the part sales trying to get that 20% is not only the capacity to get parts, but also maybe there's not as many repairs going on too?
Well, I don't find that there's not as many repairs, because as these customers get bigger, it's almost a part of their business plan to bring their machinery in and get the winter service done on it. It's because they got hired men. There are no more owner operators on this stuff, or not like there was. So it's just, I mean, maybe you can't do it. Maybe we shouldn't let some of these farm co-op stores have some of our business. We need to get that back. We need to become better marketers. Some of the best parts guys I see in these ag stores are hired from Napa or Auto Parts Plus, they know how to market the showroom. They know how to work a parts guy, a parts customer. They know how to upsell on that counter. But the training in that just needs to go up. And I know Kelly's doing a lot of training, and there's a lot of stores saying great things about it, that their parts sales are improving and they're upselling off every ticket.
Yeah, it's true. I mean, I've seen the job that Kelly has done and the increase in part sales that dealerships have seen after they take his advice and do some of his processes that he recommends. So that would be something for dealers to think about.
Yeah. Yeah. Next slide, please.
Yeah, parts gross margin, I think the target is 30%. We went a little bit above it in 2019 or 2020 study at 31%. You see the dollars also increase a little bit. So, that's promising anyway, Trent, right? I mean, we did see a little bit increase in margin. And again, this is North American average. So when you look at the study by volumes, you might see a little bit different margin percent, but this is the North American average. Okay.
Yeah, this is North America. So what concerns me here is we know, Kelly and I know, we've got lots of dealers that are getting a 32, 35% gross margin. So that means there's a lot of dealers still only getting 25% gross margin on parts, which it is going to be very difficult to cash flow your store and to show any kind of a return on your investment when you're only getting 25% of parts. But I really want you to look at the middle column where it's 30% in 2018 and it's 31. Doesn't seem like it's that much, but look at the dollars. It's another $200,000 of cash. And accounting departments like cash to pay bills. $200,000 pays a lot of extra bills. So just don't get focused and say, oh, my store is getting 30% gross margin. I'm hitting the target. I'm great. You've got to always look at the margin dollars because it takes margin dollars to pay bills. Just want to get that through. That percentage doesn't tell the whole story.
Right. I agree. And margin dollars probably tell a bigger story than actual percent anyway, because I'd rather look on actual margin dollars than a percent. I mean, look at 2018, you had 30% margin, but only 587 in actual margin dollars. So that's a big difference between 2018 and 2019. And you still only had an increase of 1%.
Yeah, what I use percentages for quite often is to compare year over year, quarter over quarter, month over month. The margin dollars is what you focus on annually to figure out, can I pay my bills?
Yep.
Next slide, please.
Go ahead, Trent.
Well, service sales is the same thing. I mean, it's growing right alongside with parts and with whole goods, which is great because it was all balanced. But because it's so balanced, we haven't improved from 5.7 in 2015 to 6.5. I mean, it's changed a little bit, but essentially you're staying within the same 1 percentage point. And to get this up to 10, if you had parts at 20% and service at 10, 30% of your total store sales would be an aftermarket, hitting the kind of margins that you should hit. You've got a lot of cash. You're in a real driver's side of the business to pick and choose what kind of whole goods deals you want to walk away from, which ones you want to take. But you need to get this aftermarket up.
Yeah, I would agree. I mean, if you could hit the 10% target, I mean, that would free up a lot of cash flow for you to use for other purposes, other expansion or facilities or employees or employee benefit programs, things of that nature. So, yeah, I mean, I think, that's something that Dealer Institute can help dealers with service sales and if you can get that up another 3.5% on, say 1.5 million in revenue, that draws a lot of cash to the bottom line.
Yeah, and the other thing you don't want to do, and Kelly and I run this quite a bit, parts and service aftermarket, when you grow those businesses, you don't want to grow them internally. You don't want to just dump all that parts and service onto whole goods items that are sitting out in the yard. Grow it through customer business. That's where the cash is.
Yeah, I agree because you can always play with that absorption rate and things of that nature and what service is providing to the bottom line. But if it's all coming from internal work, that usually doesn't increase the bottom line. In some cases, it hurts it because most of that internal work is on used equipment. And if you can't sell used equipment and make a good margin on used equipment, then what have you gained, right?
Yeah, it just becomes trapped cash is what I call it. So
Yeah, yeah.
Next slide, please.
Yeah, service gross margins, target 60%. So we went quite a bit above in 2020 study, and the margin dollars, I think, are just as impressive, 629 too. So I think that's a fairly good positive North American increase.
And the margin percent. I mean, I've worked some dealers that are 75 and 78. There's a lot of dealers getting into the 70% gross margin in service. And so what bothers me is I know there's a lot of dealers now getting only 50% in gross margin and service. I mean, this is the average for North America, but boy, tear into your data and find out, because this is the highest margin department in the store. You need to be getting every nickel out of here and more, making sure that this sucker is at least 60%. If not, get her up to 65 and 70, and let's get this going. This is where the money can be made, right here.
Yeah, I would agree. I think if you look at your own financials and you're only making 50% margin off your service gross margins, then that's the first thing I would really want to fix. You're right, Trent. I mean, that can provide a lot of cash to the dealerships, especially coming into the winter months.
Yeah, and you might as well don't add any service techs. Think you're going to add gross. You just need to get the service techs that you have and the work that you have, make more margin on it. Easier said than done, because you need quality techs to do that. I appreciate that.
Yeah, it's true. And techs are hard to come by and hard to keep. So, once you get that good tech, you got to keep them. You might have to pay a few more dollars to keep them, or a few more dollars in employee benefit programs, that nature. But as you can see how big of an important and big impact difference of service gross margins and your margin percent can make in a dealership.
Yep. Next slide.
Yeah, total expenses, target is 12%, and we're at 14.6 average for North America. Again, you look at the different volume categories, you see quite a few dealerships at the 10% expense percent of revenue. So that makes that 14.6. You got some people operating at, an 18% expense of revenue, which is a little bit scary.
Yeah, and then, looking at these, when we go into a dealership, one of the first things I look at in their financials is what this ratio right here, what is their expenses a percent of revenue? And if I see a single digit, I know right away they're making money without knowing anything else. If they're at 8 or 9%, they're making money. But when they start getting 15 and 16, then I start to say, you're probably not making any money, because it's just too high you just can't get enough gross margin dollars. It's too competitive in this industry to cover that kind of expense structure. So this is a big one to watch. You can see his expenses, from 18 to 2020 jumped almost $540,000. Is that? Maybe I done my math a little wrong, but close to it. So we've added a lot of expenses. Now we've added a lot of growth too. That's good. We've gone up 30% growth, gone up 30% expense, but man, I like growth without adding expense. Just make more money with what you have versus adding more people.
Yeah, I guess you also got to look at your individual dealerships, because there's some dealerships, that do have a little bit more gross margin revenue than some of the bigger farm equipment dealerships. And so maybe their expenses are maybe 17 to 18% of revenue, but their gross margin's a lot higher than normal. So bottom line is still very good. So I think, you have to look at your own unique situation also, because I have seen that in quite a few dealerships, haven't you?
Yeah, I agree with that. Absolutely. Everybody is unique to this one, but there's nothing like saving money on expenses. That's for sure.
Right. I mean, no matter what dealership you're in, if you can keep it at 12% instead of 18, you're just increasing your bottom line. That's for sure.
Next slide.
Go ahead, Trent.
Okay, this is one that not many people in the industry watch this, but it's a major one. So how do we spend our gross margin dollars? And for some of you guys, you probably use how do we spend our available income dollars is kind of how some people rephrase it. But as a percent of gross margin, salaries should be under 40%. And you can see that we're not too far off from that. I mean, the guys that are under 25 million are at 40, and the other ones are at 37. So we're doing very well there. We're keeping our salaries in check as to how much money, how many dollars, salary dollars we're spending of our gross margin income. And then occupancy should always be under 10%, and we're doing okay there. So this was very promising when I drafted this up, thinking, good, there's room for every category to make money because these are the two biggest expenses in the store. And these two combined used up 50% of your gross margin dollars or your available income. So we're keeping just under that 50%. This is very promising.
Yeah, I would agree, especially, you know, the way salaries are nowadays, especially with techs and parts and anybody really. I mean, you got to be very competitive or you're going to lose good employees. So yeah, it's good that basically everybody's at 40% or less, and also the occupancy, especially, you know, the bigger volume dealers are hoovering just right at 10%, which is good because they do have a little bit more operating expenses involved in occupancy. So that's understandable. So yeah, it's a very positive slide.
Yeah, room for everybody to make money with these kind of data, with this data here. Next
Can you
slide.
please
please.
explain what occupancy is?
That would be like your rent and real estate taxes, repairs and maintenance, utilities, things of that nature.
Okay.
Yeah, profit from operations, as you can see, profit as a percent of revenue, 1.6% in 2020, and in 2019, 2.6. So we did see a drop in that. And, you know, I think it probably goes back to your comment on, you know, selling used equipment and selling it for whatever you could get. And, you know, it kind of decreased the overall net income that we saw in 2019 study for the year 2018. So I think that had a lot to do with the profit as a percent of revenue.
Yeah, and the industry target is 3, but I've had a lot of dealers telling me that they've thrown 3 out the window and their industry target is 5 plus 5 because they're just not going to do this much work and put this much risk of their own money on the line and not earn at least 5% on it. So that, you know, take it for what it's worth. And I don't know if the cost of doing business will change the target or not. This isn't our target. This is an old target from a long time ago, but you can see we're still not even there yet. We're not at 3 as a North American average. And then I look at the next column, the interest dollars, which we spend a lot of money in this business on interest. And if that interest money, if we only spent half of that, what's on the screen here, and it spilled over into, you know, it'd become profitable dollars then because interest is not recoverable. So we're just throwing it away as we pay it. We can't get it back. I mean, if we could cut that number in half, that could go right to the bottom line. That would spill over to the column on the left. But I just wanted to point that out.
Yeah, and you know, I think part of the higher interest dollars for 2020 equate back to, you know, we saw a little bit of an increase in total inventory dollars, if I remember correctly. So that would equate into more floor plan interest being paid. So I can see that happening from 2019 to 2020. That's not alarming, but you're right. I mean, if you can cut that interest dollars, and that helps the bottom line overall. And I agree with your comment that you made. I mean, there's a lot of dealerships that are making 5% or more, and that's their target goal. And so that means, you know, for the North American average to be down to 1.6, you're seeing quite a few that, you know, aren't making hardly anything really, because if you take some that are making 5 or 6% profit as a percent of revenue, then you got some that are making 0 to, you know, minus.
Yeah, that's for sure. And I actually was pretty impressed that each location only spending about $100,000 in interest the last few years, because I would have thought it would have been higher. I mean, last year was only $10,000 a month per location. It wasn't that bad for some of the horror stories that I've heard from dealers telling me how much interest they're paying.
Yeah, well, and it's not quite unusual to see because, you know, the interest rate has been dropping, especially in the United States. So I can see those dollars not increasing very much. And in fact, actually in 2020, the interest rates have dropped even more than what they did in 2019. So it'll be interesting to see, in the study next year what the actual dollar spent for interest is, because I also think that our inventory levels are going to be decreased in 2020 compared to our 2021 study compared to our 2020 study. So I think, you know, we might see a big drop in interest dollars spent really for the coming year.
Next
We had
slide,
a
please.
question on the interest expense. Does that include floor plan and all other loan interest?
Yes. On the study, you'll see it's broken down what amount is actually floor plan interest and then what is other interest. But that amount that we're talking about in the previous slide actually includes both interests. Okay, on the returns, return on assets, you know, you saw the diminished return on profits. So you're going to see a drop on return on assets and return on equity. And plus we saw the drop in total equity on the balance sheet too from the previous slide. So it's not unusual to see a drop in return on equity and also return on assets. As you can see, the target is 6%. In last year, 2019 study, we were right there for return on assets. As you can see, return on assets is 3.2%. And also on return on equity, it dropped 1%. So that part's somewhat positive. The return on assets is not so good. Do you have any extra comments on that, Trent?
No, it's just when you see an equity drop like on that prior slide of 7 points, you're going to see a return on equity is going to go up. So what I just want guys to just don't focus on this and say, oh, our equity, look at how this number improved from 2018 to 2020. Well, it did improve, but there's a lot of other factors behind the scenes that made that happen, and not in a good way. It's because the equity was reduced, that the return on equity went up. Now that's great if you can have less equity in the store and only use that amount of equity to do the same volume of business. But boy, you start turning your working capital up in 10, 12, 15 times, you're getting in trouble. You could be in trouble if things really slow down. So you've got to watch that.
Yeah, I would agree. Employee average, I'll let you comment on this, Trent, because as you can see, there was an increase in revenue and revenue per employee, and especially because we had a drop in employees.
Now, this is one that I watch this quite a bit to see if we got 20 people working at a store, how much volume are we doing out of that store? And we're staying right in there. Now, this is US dollars. So in Canada, if you convert this, I usually say 20 people at a store should do $20 million worth of business. And once they get over $20 million, that store is likely making some money when you're doing more than $1 million a man on Canadian business. So we're doing fairly well here. I'm kind of liking this because we're keeping our employees in check. You've seen what our wages were as a percent of gross margin dollars. And this is very promising too. We've got lots of room here to make money in the business. We've got the right amount of people in the store for the volume that we're doing.
Yeah, I would agree. And then also, you know, if you can make a little bit of a change in the parts margin and service margin, then that total store revenue would go up even more. And then that revenue per employee would actually go up quite a bit more. So yeah, it's very, very positive. And we had a question that, is this Canadian or US dollars? It's all US dollars that's in the chart.
Yeah, this is all US. Yeah. So where this changes is, let's say the dealership is primarily selling under 100 horsepower tractors, but so they might have 20 employees only doing 12 million or $11 million worth of business. But you also know on that smaller stuff, they're not getting 5 and 6 percentage points gross margin. They have to get 12, 13, 14, 15% gross margin on that small stuff. Even the real small stuff, the $5,000 and $6,000, $10,000 items, they got to get 20%. So it balances out, but just keep your eye on this all the time as where you should be, where you're at. Next slide, please.
Yeah, I'll let you talk about this one, Trent. This is right in your wheelhouse again.
Yeah, I like absorption. I like parts and service paying all the bills of the store. And you can see, you know, parts is right up there with the mid-sized guys and the large guys. Look at how much those over $75 million guys are just about at 40%. that's because they're getting that 32, 35% gross margin in parts. And it shows right here. This is where it comes home to roost, and it's really feeding it. Because then when I look at total absorption at 67% on those larger complexes, boy, that says a lot, because they're moving the needle. Like my dad said, they're figuring out how to do it. Now, they're not anywhere close to 100, and should they be 100? I don't know. Some dealers can get 100, but that under 25 million at 53, there's a lot of room for improvement there. We're missing the boat. There needs to be some more money made in parts and service in order to justify, the expenses of the store.
Yeah, I would agree. And then, I think realistically, don't you think, like for the higher volume dealer, I mean, if they could actually have total absorption of 75%, I think everybody would be tremendously happy. And maybe in the middle volume, if they could get to 62, 63%, and the smaller volume maybe get close to 58%, I think, you kind of got to break it down between categories. I mean, there's only so much that, a dealership of under 25 million, it might be fairly hard for them to get like a 70%, 75% total absorption, don't you think? I mean, it depends on how much internal charges you have too, correct?
Yes, and you gotta, are they charging the same rate, internal labor rate, and do parts get a discount when they go through the shop? That happens a lot on those, on the under $25 million stores. We're still finding that happens. So that throws it off. But no, I challenge every parts and service department. They've got to grow that. They've got to grow in order to meet absorption requirements or absorption targets. It's there. You just have to get really creative and get thinking. You have to, don't think like you did yesterday. Think like you can tomorrow. Just pretend your life depends on it. We're going to get it done no matter what.
Yeah, I mean, don't you think all categories, especially in parts absorption, shouldn't that definitely be at least, the higher volumes at 37%, but the two other categories, that should be at least 32 or above, don't you think, for parts?
Oh, absolutely. And a great big thing is when dealers move this needle by only 2 percentage points in 1 year, it doesn't seem like money. It looks like a very small, but it's a very big deal to go from 58 to 60 and then to 62 and then 60. This doesn't happen overnight. This takes some time, but I've seen some dealers have some 5 and 6 and 7% jumps year over year in absorption. And it just makes a world of difference in that store as far as the financial health of the store.
Yeah, and don't you think also that if you actually have an increase in one, especially like in parts, that would kind of roll into the service to make that a more positive increase?
Yeah, absolutely. If parts grows, service should grow, because that's where most of your parts are in this business. A lot of your parts are running through that shop. You bet.
Yeah. And then again, here's the, gross margin per employee broken down by categories. I think we kind of discussed that on the last screen. Yeah.
We have two questions related to absorption. The first one is, what should a respectable absorption goal be at?
Well, so a long time ago, absorption has got a funny calculation because it used to be total store expenses divided by, they used to back out sales expenses. They used to back out sales commissions. I've even seen some stores back out everything associated, all the advertising, everything associated with whole goods. So it's really not a true full, they're not using the full calculation or the calculation with the full expenses, I should say. So instead of everybody having different numbers, what we've gone to is, okay, just use all the expenses of the store and let's have an absorption target of 80%. And that way there's a little wiggle room, because it's very hard when the salesman makes some of these big high commissions for parts and service to cover that as an expense, because some of those guys can really make a lot of money in a short order of time, and parts and service just can't keep up to that. Now, I do have some guys that said, to heck with that, we're going for 100 regardless. So, but I mean, if you're hitting 80% absorption rate, good on you. You're doing very well.
Okay, and then the other question was, How does this change with your product mix? So like if you sell more consumer than ag?
Well, it's always going to be a little tougher with the consumer stuff, but to have a higher absorption because they just don't have as much parts and service work. But I'll say on the other hand, I've got a lot of those stores that are selling that kind of stuff that run a lot of their handhelds or even riding lawnmowers. They run it through their parts department because the salesmen, they're trying to sell 100 horsepower tractors or 80 horsepower tractors. They're not messing around with a little lawn and garden thing. They let the parts department sell it. Then they don't have to mess around with how much commission we pay on that thing. It's just a product in the parts department that's managed and inventoried well, and they sell it to the consumer. And it seems like they can grow their parts because now recognize that maybe a lawn and garden mower might only bring you 22% gross margin. So you might want to separate your financials out so that you can see what parts are bringing for gross margin and what parts whole goods type items are bringing for gross margin. But get creative. It can work. So.
Yeah, and that's a whole Dealer Institute team that has been in service to all the different dealerships across the United States and Canada with various different programs. Dr. Larry Cole with leadership and customer service management, Kelly with aftermarket parts and service, Trent with whole goods, operation, sales, performance evaluations, Gord with financial management, merger and acquisitions, Jim Vicente, customer experience, mystery shopping, and Jim Welch, executive team coaching, marketing strategy. We have Michael Piercy, vice president of dealer development DI for custom on-site consulting, performance group. So, and then we got Jennifer Luce, our chief operating officer for WIDA, that also helps with the Dealer Institute. And so if any dealers have any questions on any of this, I would advise that they reach out to WIDA and to DI, and I know this team can help a dealership grow, improve gross profit, and also the bottom line. Trent, do you have?
I just want to say, guys, you don't have to be hired. If you just have one question, you can phone in and ask us one question. Lots of dealers do phone in and say, well, what should I do about this or that? And the office directs the question to whichever trainer is a specialist in that area. And then we just phone you and you talk about it on the phone. There are no hard feelings about that. We enjoy doing that, helping a dealer move his store ahead. If it's just a simple little question about what's the value of different commission structures, they run it by us as a sounding board. That we do that all the time for dealers. We're part of the association, so we're there for your use.
Yeah, and also the dealers know that they can call the hotline at Western, and we'll answer questions for sales tax, human resource questions, things of that nature, and also equipment dealer consulting. We do certified audits, business valuations, tax services, and we're also heavily involved in mergers and acquisitions across United States and Canada. All right, time for questions and answers. I guess, Kim, do we have any questions?
Yeah, we do still have a few questions. This is going back kind of to the very beginning of your presentation, but what's the targeted for new and used whole good turns?
Oh, I would say probably at least for whole goods turns, new and used. I'd say new probably for three times, and maybe used 2 times. What do you think, Trent?
Well,
I mean, realistically.
If you're selling under 100 horsepower stuff, you're probably only going to get 2 turns because you got to stock so much of that stuff. It's a consumer type. If it's not there, they don't buy it. But the big iron, because of pre-sales, and we probably got to get back to that, doing more of that like we did in 2008 when there was all kinds of articles said that we'll never go away from pre-sales, and we did. But I mean, you should be able to have a higher turn in new because we're pre-selling so much of that large iron. And so I've seen 3, I've seen 3.5, whatever you want to use is fine. And the used, I don't think it should be any different. You've got to be turning at 3 and, well, really, I'd like to say 4 because then every 90 days your used is turning over. And some guys say that's impossible. And they're probably right. Not every piece can turn over in 90 days, but you got other pieces that are turning over in 15 days. So on average, it's 4 turns a year is where you need to be in order to cash flow this. Bring down your expenses and keep current with fair market values of what this used stuff is worth versus sitting on it for 2 and 3 years when, I mean, the market just does crazy things over 2 years and then all of a sudden you're $100,000 upside down on a piece. So
All
that's
right.
my status. Anywhere from 3 to 4.
Yep.
And then when you were talking about the employees, which employees were you counting in the employee count when you were talking about $750,000 per employee?
I count every employee, even the floor sweep. So if he's a head count, he's a head count. So it's not just ones that generate revenue or ones that generate revenue plus management. It's the reception, it's the floor sweep. It's if I got a part-time guy, I make him a 20.5. So it's everybody. Count everybody in the store because they're all part of the team.
Okay. And then with the total interest expense, is there an industry maximum target?
Kurt, have you ever seen an industry maximum for that?
No, not really. Not as far as dollar wise or a percent.
Percent.
Well, I think probably a percent. It goes back to our slide. The target would be. I think it was 10%, right? So I think the industry's that probably around 0.8 to 8% to 10%.
No, what this question is referring to is your total interest expense as a percent of sales. And it's at 0.8, 0.6 is what historically it's been on the slide.
Oh, okay. Yeah.
I mean, ideally you have zero. You don't want to pay any interest. I mean, that's not possible, but no, there is no maximum target. I've never seen it listed anywhere in the industry ever.
No, as far as the breakdown between volumes per store, just on floor plan interest, under 25 million, it was 0.54% of total revenue. For 25 to 75 million is 0.49%. And for anything over 75 million, floor plan interest was 0.2% of total revenue. So I don't know if that helps answer the question or not.
There is no maximum target.
Yeah. I've never seen it. Yeah. Because it just varies between dealership to dealership and actually the cash flow of the dealership and how much money they pull out for other things as compensation, rent, things of that nature.
Anything else, Kim?
We got one more question, and it's more just about Dealer Institute in general, but do you guys have online courses or webinars available?
Oh, go to the next slide. Move the slide ahead.
Oh, that was the last one. Oh,
there you go.
There you go.
Sorry. Yeah. So
in fact, that October 27th, I believe, got moved to December 2. Okay. I'm not sure, but you can email Michael Piercy, but I think I saw something where the October 27th is now December 8th.
I had a phone call this morning that I'll share with everybody. I had a dealer ask me on this. They knew we were doing this cost of doing business. And he said, what's the used as a percent of rolling 12 new and used sales? Because this is a big metric that we watch to try to help us manage how much used we should have in comparison to what our revenue dollars are. And so the under $25 million stores are at 8.5%, which is great because the target is to be under 10 when you're in the big iron business and probably under 5 when you're in the hay and forage business. And we're in the metro business or the consumer business, you want to be well under 3%. So the mid-sized dealers, the 25 to 75 million is at 15.6. So they're still sitting a little bit heavy in their inventory for the amount of new and used sales that they have. And the plus 75, the larger complexes, they're at 17% of their used as a percent of rolling 12 new and used sales. So there's some cleanup to do on used equipment still, or there was at the end of 2019, which is where these numbers are coming from that I have. Now, it'll be very interesting to see the 2021 study, how much this changes. Because I got a feeling I'm driving by yards all the time and I'm seeing some really empty yards that used to be just jammed with stuff. Empty to the point where I'm sure customers are wondering, are they still in business? Well, An empty yard is a good yard in the fall.
Yeah, I would agree because I've started some inventory observations and a lot of lots are empty or have a lot less inventory than what they did a year ago.
Yeah, we're in good shape right now, but for the most part, I'm sure everybody can drive down the road and find one dealer that didn't act on cleaning out their inventory this last 6 months. But for the most part, I'm seeing very good things, very promising.
Yeah, especially on used, now it's kind of, questionable whether the decrease in new inventory on the lot is good or not, but you can debate that back and forth. And I think also COVID-19 also had a little influx on inventory and how it's produced and what goes to the dealership. So I think part of the decreased new inventory is because of the crisis we've been battling since March. I mean, the production has kind of slowed down.
Sure, I'm sure that the manufacturers are not screaming for orders like they were a year ago. I'm sure they're getting orders like crazy and don't know how they're going to fill them. And
yeah.
Nothing OEM hates more than fluctuation in orders. They like to be consistent because that's how you run a manufacturing plant, is consistency.
Yeah. So it'll be interesting to see the 2021 study and actually how 2020 ends. As far as the revenue growth for the actual year 2020, I think from what I've been hearing, it's been very positive. So it'll be interesting to see the final numbers through the push through the next 2 months that we have in November and December.
It will be. And anything else, Kim?
Nope, that was all of our questions, and we are just a little past 3, so I think a good place to wrap up.
Very good, everybody. Happy selling. Good luck.
All right. Thank you, everybody. And thank Farm Equipment and West Texas National Bank and Iron Solutions. Have a good day.
All right. Thank you, guys. Kurt, Trent, everyone at WIDA. And on behalf of the Farm Equipment staff, thanks for joining us for the webinar. There'll be a short survey when you leave. Let us know what you thought and if there's any topics you want us to cover in the future. And then enjoy the rest of your day.